Negative cash flow. What causes it? What does it indicate about a business? And how do you analyze it? Hey, and thanks for tuning in. Holly Shields here for kalkinemedia. The cash flow situation where a business has utilized more cash than it takes in results in what we call negative cash flow. It generally happens during the initial phase of a business where the company struggles with funding and has much more expenses to cover. Negative cash flow can be caused by a number of things, namely generating a low profit. When the company fails to recover its operating expenses by selling its products or services to its customers. Secondly, excessive investments. We know that investments are made with the expectation of earning extra profit. However, excessive investments ultimately drain from the funds and give a negative cash flow to the company. Also, poor financial planning. Essentially, failure to plan investments, expenses, and strategies to overcome all the cash outflow through sales and investments. Unpredicted expenses. These often start appearing in a business that was not initially included in the plan. High unpredicted expenses might exceed the cash outflow in a company and give rise to a negative cash flow. Expensive cost of overheads. Overheads are the additional expenses that are involved with the production and operations of a company. Sometimes these expenses become higher than expected and become a cause for a rising negative cash flow in a new business. Product pricing. Either too low or too high. The cost of the products must be kept moderate, keeping the market prices in mind. If your products are highly priced, then customers might not be able to buy your product. So what does the negative cash flow indicate about a small business? In short, a loss of money. In certain cases, it also indicates the wrong timing of investments and income in small businesses. When negative cash flow prevails in a business, the primary focus of the business should be to recover losses and achieve a positive cash flow as soon as possible rather than reinvesting. A negative cash flow is the fruit of poor decision making on the part of the company's management in terms of investments, and it also makes investors skeptical about investing in that company, as negative cash flow also puts a question on the growth of the overall business. So how can you analyze negative cash flow? The analysis and calculation of negative cash flow are simple. Although the mathematical formula gives a practical value of cash flow, it's important to analyze business activities to develop a clear understanding of negative cash flow. We need to calculate the cash flow first before determining the negative cash flow. The mathematical formula to calculate cash flow is this. Cash flow equals cash inflow minus cash outflow. If the value of cash flow is obtained as a negative value, it can be concluded that it's experiencing negative cash flow. Now that you're up to speed, check out some of our other videos to boost your financial IQ. If you like this info, please give us a like, share, and a comment, and sub to our channel while you're at it. This has been Holly Shields for kalkinemedia.